Good morning. So it's been about 2 weeks since I did my Magic Formula video, and one of the stocks on there was Mastercraft. It's one I really liked at the time, but right after the video, it had this big run up. I mean, it was sitting at like 28, I think, whenever I did the video. Maybe, yeah, right at 28, it ended on the Friday, July 21st. And then I was like, okay, I really looked into it all weekend. I was probably going to buy some Monday, but it went up like 2% or something. I was like, okay, that I'm not going to wait for it to come down. And then sure enough, boom, went up 10% plus because of this $50 million stock buyback program. And, that's always a good thing, right? That's close to 10%. No, it's over 10% of the market cap that they've authorized for share repurchases, okay? Really a good sign. Now, what happened in the last 5 days, though? One Water Marine, this is what I think. They announced earnings, they had huge inventory growth, and their stock was down close to 30% in one day, and that drug all the boating stocks down with it. So I saw this as a great opportunity because I think falling because of competitors' poor inventories or poor results is one of the best ways to jump into a stock. Okay, I think it's usually overblown. So I actually started a position around this mark, and of course, like every stock I buy, it's almost impossible to time the bottoms. So yeah, I'm already down. So I wanted to do a video on Mastercraft's financials, really just centered around the discounted cash flow model. It's going to be quick. I'm going to run through the balance sheet, and then we're going to look at the free cash flow, and then that's it. All right, so let's get started. I have here their what is this? Their 10Q from the quarter ending like at the end of March. Let me turn on my cursor. Okay, now you can see my cursor. Okay, the balance sheet. Let's see, current assets. This is one thing. Look, it's a Magic Formula stock. It's going to have a pretty good balance sheet. So, current assets, $186 million. They have enough current assets to pay for all of their liabilities. Okay, that's huge check mark there. I mean, it means they don't have a lot of debt. Look at this. Their debt, long-term debt's only $50 million. And, cash, they have $30 million of cash and then $70 million in held to maturity securities, which, if you look at it, is, I think, corporate bonds. But anyway, that's enough about the balance sheet. Like I said, that's the beauty of the Magic Formula. Is usually, if you screen with that, you can rest easy knowing that the balance sheet's in pretty good health. All right, cash flow. So the big thing I'm looking at here is stock-based compensation, because I'm going to use Seeking Alpha to get a trend for the cash flow. All right, so share-based compensation, about $3 million for a 9-month period, so 2.892 for a 3-month period. So what would that be on a 4-month period or a full year? About $4 million a year in stock-based compensation. That's 1% of the market cap. That's insignificant. So I'm not going to really need to factor that into the DCF. Okay, let's run back to Seeking Alpha, and I'm going to show you the financials, and we're just going to the cash flow statement and going all the way down here to the bottom to free cash flow per share. Okay, so there's a big jump, right? It was $1 to less than $1, $3, and then, trailing 12 months, it's going to be $6.50. So what do you use moving forward for the discounted cash flow number? Because this has a huge impact, right? That's one side of it. The other side is what growth rate to use. I'm going to say that all this COVID stuff, so 2020 on, it's hard to judge if that's going to be their continued performance moving forward. So I'm going to instead go back, look at, let's do this, 2014 to 2019. Okay, so $1.66 to $2.24. What was that growth rate? That growth rate was, and look up here in the calculator, 2.24 divided by 1.66. So 1.35 times in those 5 years, right? 2014 to 2019. So I'll raise that to the 1/5, and you can see my growth rate's 6%. I mean, it's like, okay, minus 1 times 100 if you want to be precise. 6.2%. So back to the free cash flow number. What are we going to pick? Okay, I'm going to do multiple scenarios for you. Okay, so the first one I'm going to do, I want to look at what happens if the next year they split the difference between this 650 and this 312? Okay, so what's the average of those two numbers? So 6.54 plus 3.112, 3.12, 3.12. All right, divided by 2, 483. Okay, so this will be our optimistic scenario. 483 and the growth rate was 6%. Let's go to the discounted cash flow model. Okay, so like I've said before, I'll send this to you for free. Just email me, send me some message so I know you're not a robot. But anyway, I'm going to put the 483 here. Okay, growth rate, I said 6%. I'm going to be a little more conservative and say 5%. And then discount rate, I like to use 15% for many reasons. It helps you stay consistent, and it's a little harsher, so it keeps you from overvaluing things too much. The other thing is that it kind of works out to exactly a 10x multiple on a 5% growth rate. So like, 483 is the cash flow, and then the terminal value whenever you discount this back for 100 years is 48.29. So it really is like a 10x multiple. So that's kind of convenient for me. All right, so this to me is the high-end scenario. The stock could be worth $48 a share, if they make cash flow 480 and grow that at 5% a year. I think that that's actually pretty conservative with these assumptions because the discount rate's pretty harsh, okay? So that's really strong. Now, let's say they don't do that. Let's say they go back all the way to that 312. In that scenario, the stock's still worth $31 a share, which while it's not, a great upside, it's still, what is this, 12%? It's still 12% higher than it is now. And once again, I use this big discount rate of 15%. If you were to instead use something like 12%, then you see you're back up to that $40 range, okay? So that's interesting, but okay, let's take it one step further. Let's say that they're going to have, a bad year in there. So they're going to go back down to that $1 a share for a whole year. So what I'm going to do is I'm going to take these, I'm going to say 312, then they're going to make $1, then go back to 312. And then from there, grow 5%. So now my terminal value, $27 a share. So a little bit lower than it is now, but I feel like that's very good downside protection. And you know what? I'm going to go one further. Okay, I'm going to say 2 years, making only $1 a share, then only back up to the 312. Okay, so this to me is like worst case scenario. You make about $3 a share next year, then, you have some kind of terrible recession in 2025, that sort of thing, and you discount it 15%, okay? In that scenario, you're still $24 a share terminal value. So, it just seems like you have very good downside protection with this stock, and that's something I like. I was looking at a stock last week that was kind of the opposite, where I think you had the downside was bankruptcy and zero. That was RYAM. And then the upside was huge. This one I think is a little more of a safer bet. And you also have the added benefit of knowing that it's a magic formula stock. So there's that. But that's just my 2 cents. I hope you enjoyed the video. Leave a comment, subscribe. You know the drill. I'll see you next time.